You've probably heard about the 530A accounts or Trump accounts and are wondering what the heck are they? Depending on your situation, it could be a great tool for you and your family, but it could set your kid up for a massive tax headache decades from now too. I'm Jeff McDermott, a certified financial planner at Career with Financial Planning, and in this video, I'm going to walk you through everything you need to know, what these accounts are, how they work, the interesting planning strategies around them, and the real caveats that most people are not talking about. This is one of those areas where the details matter a lot. So, what is a Trump account and who's it for? First things first, Section 530A is just the section of the Internal Revenue Code that defines and governs these accounts. You've heard similar labels before, like 401k, 403b, 529, same idea. Congress writes a rule, gives it a number, and then the account gets named after it. In this case, someone decided to give it a more memorable nickname. So what actually is it? A Trump account essentially functions like a traditional IRA for minors, but without the need for income to contribute and without any upfront tax deduction. The child's the owner of the account, the parent or guardian acts as custodian and manages the account until the child turns 18. After that, it converts automatically into a standard traditional IRA, and from that point on, normal IRA rules apply. Any child under 18 with a Social Security number is eligible. No earned income is required. That's a big deal. We'll come back to it. So how do you open one? Well, the government set up a dedicated website at trumpaccounts.gov for this. You can also open accounts through participating financial institutions. As of now, the two primary custodian options that have been announced are Bank of New York Mellon, which is the U.S. Treasury's designated as a financial agent for the program, and Robinhood, which has also been announced as a platform partner for account access and administration. One important timing note, contributions cannot be made before July 4th, 2026. So this is not something you can fund right at this minute if you're watching this video before then, but you can start planning now, which is exactly why we're talking about it now. Now, how do contributions work? And this is where things get a little interesting. There's a few different types of contributions that you should understand. The basic annual limit is $5,000 per child per year from the IRS. That total can come from parents, grandparents, family members, friends, pretty much anybody, even the child can contribute money themselves. No earned income is required, and up to $5,000 a year per kid. That limit is set to be indexed or grow with inflation beginning in 2028. So again, it will change over time. Now, employers can also contribute. Under a related provision in the tax code, employers can put up to $2,500 a year into Trump accounts per employee for their account if they're under 18 or for that employee's dependent. The employer contributions are excluded from the employee's taxable income, so it's potentially free money for you or your child. Employer contributions do count against that $5,000 annual limit though, so think of it like combined direct contributions plus employer contributions cannot exceed the total of $5,000. Kind of like an HSA where you have your contribution and the employer contribution, if you're familiar with that. And there's also what the law calls these qualified general contributions. These contributions can be made by certain governments or charities to broad classes of beneficiaries. The big one here, for example, is the federal pilot program for any child born between January 1st, 2025 and December 31st, 2028, who's a U.S. citizen with a Social Security number. The Treasury will deposit a one-time $1,000 seed contribution into their Trump account. No personal contribution required to get it. It's an example of that free money. These qualified general contributions do not count towards the $5,000 annual limit. So in a best case scenario, a child born in 2025 could potentially get $1,000 from the government, plus $2,500 from an employer, plus $2,500 from family, and none of that exceeds the annual cap, a solid $6,000 start. Now, what can the account invest in? During the growth period, which runs from the account opening through the end of the year the child turns 17, the investments are restricted to low-cost, broad-based U.S. equity index funds or exchange-traded funds that track things like the S&P 500. Expense ratios must be 0.1% or lower. No individual stocks, no sector funds, no real estate funds, no crypto, just simple, boring index funds. And honestly, for long-term accounts, for a minor, that's not the worst thing in the world. Broad U.S. equity index funds are diversified and easy to stay invested in. Keeping costs low also matters a lot over decades. Personally, I do wish that we had some access maybe to international funds, international equity indexes, but the investment menu does expand once the account converts to a traditional IRA at age 18. What happens when the child's 18? At 18, the account becomes a standard traditional IRA. Normal rules kick in. Distributions are taxable as ordinary income. Early withdrawals before age 59 and a half can trigger a 10% penalty plus tax. Exceptions exist for some things like qualified higher education purchases or maybe a first-time home purchase. Now, one thing a lot of people might miss, these accounts are funded with after-tax money. There's no deductible basis inside the account, so a portion of the money has already been taxed. You need to track that basis on IRS Form 8606 with your tax return every year. If you lose track of that basis, you could wind up paying tax again on money that was already taxed. Not good. Now, distributions are also subject to what's called the pro rata rule, which means if there's both taxable and non-taxable money in the IRA, you can't just choose which dollars come out. Every distribution is a proportional mix of both the taxable money and the tax-free basis. Something to keep in mind when planning withdrawals. Another thing to be aware of. At age 18, the child takes full ownership of the account, or the age of majority in their state. So just like a custodial account, it's a real consideration of whether you think your 18-year-old will be financially mature enough to handle this account at that time. Now, there's a few advanced strategies we can think about with these accounts. First one being Roth conversions. This is a legit tax strategy that can go along with these accounts if things play out well. Because it's a traditional IRA after the child's 18, you can convert it to a Roth IRA after that. And if the child converts early in life when their income is low, the tax cost could be very low and very manageable. Think about it. If you save and invest through childhood, when the child's a young adult, maybe earning a modest income from, work early in their career, you could look at converting the Trump account balance to Roth. You do have to pay income tax on the conversion at the current tax rate at the time of that conversion. But again, if they're just starting out their career, it could be a very low tax rate. The money then is in that Roth where it grows tax-free forever. But there are two serious traps to watch out for with this scenario. First off, the kiddie tax. Before age 19 or under age 24, if the child's a full-time student, unearned income like investment income above a certain threshold gets taxed at the parent's rate. A Roth conversion is like ordinary income. If the conversion amount pushes the child's income above the kiddie tax threshold, which it almost certainly would, a major portion of that conversion could be taxed at mom or dad's rate instead of the child's low rate. That defeats the whole purpose of the strategy, so work with a tax professional to plan around these kiddie tax rules. The second trap is just the idea of paying the taxes in the first place. When you do a Roth conversion, taxes are due that year. If you withhold money from the IRA to pay the tax, that's effectively a distribution from the account, which could trigger a 10% early withdrawal penalty. So the best practice for these conversions is to pay the tax out of pocket from a separate source. If you're planning the strategy from the time your child's born, you might want to set additional savings aside alongside the Trump account to cover that future tax bill. Now, these accounts do have some advantages. Some genuine reasons to consider one would be no earned income requirement. Most IRAs require the contributor to have earned income to put money into it. Trump accounts do not. So it opens the door to start tax-deferred retirement savings for young children immediately. Another option is the potential for free money. Again, the government has their plan to seed accounts for kids born from 2025 to 2028 with that $1,000. Employer contributions from participating employers, other qualified general contributions from charities or governments are all ways that money can flow into the account without the family putting a dime in. I think there's some mental accounting to think about too. It's real. Earmarking money as retirement savings, even for a child, builds that long-term savings habit and a framework for thinking long-term. And there's maybe some potential benefit in the terms of college financial aid, simply because if Trump accounts end up being treated like retirement assets in the federal student aid calculation, that balance is not counted the same way that student assets in a bank account or an investment account would. So it's just something to keep an eye on. However, these accounts come with plenty of caveats, things to think about, and you might want to slow down before you just open one and start putting money into it. For one, there's no flexibility before age 18. Zero. The money's put away, and before the child turns 18, there's no option to distribute money from the account. If life happens and you need funds earlier, you're stuck. These accounts could complicate backdoor Roth IRAs if we're still doing backdoor Roth IRAs in the future. If your child has a balance here and it converts to a traditional IRA at age 18, that freezes up the ability to do backdoor Roths without pulling in taxable money and creating problems in that circumstance. So it's just something that could wind up being an issue down the road, again, if we're still playing the backdoor Roth IRA game 10, 15 years from now. I mentioned earlier, it's got that very limited investment menu, only index funds during the growth period. That itself is probably a feature, not a bug, but limited to US indexes, no international funds, no other sorts of investments if you wanted to buy individual stocks, things like that. Just kind of limited there. There's also potential inheritance complications. Once the account becomes an IRA, if the owner passes away, more than likely that Secure Act 10-year rule will apply. There's some exceptions depending on the type of beneficiary, but it's possible you'd build up a substantial balance in these accounts, all taxable money when it's distributed, and then leave it to a beneficiary who has to pay tax over that 10-year inherited timeline. So it kind of leads to the bigger picture concern of the Trump account essentially becoming a traditional IRA. All that growth is tax deferred, not tax-free. If your child and you save aggressively into the account and the account grows substantially over decades, hey, it's a great thing, but they could wind up with a very large traditional IRA balance that generates significant taxable income in retirement. Think about this. An account that gets just the initial $1,000 gift and grows at 8% could be worth over $200,000 at age 70. And a max funded account annually for 18 years might be worth many millions in retirement. A great problem to have for sure, but it's still a big tax issue. Starting to save early is always good. The type of account, though, for tax treatment matters enormously in the long run. There's also a weird gift tax filing question that's come up on some webinars I've been on. Because these are contributions that are technically future interest gifts. The child doesn't have access to the money right away. It might fall outside of the annual gift tax exclusion, simply meaning there might be some tax reporting items to be on your radar there. Just keep an eye out for it. I don't know if the final word is there on this one yet. So the big question is, how does the Trump account compare to other options, other savings accounts that you might have? Is it the best tool for the job? A lot of people compare it to a 529 plan, which offers tax-free growth and tax-free withdrawals for educational expenses. If saving for college is a goal, 529 is still probably the strongest choice. You also have custodial accounts like UGMA or UTMA accounts, regular brokerage accounts that are for the benefit of the child, and those offer a lot more flexibility. You can put in any amount, withdraw at any time, invest in almost anything. And actually, long-term capital gains tax rates are often more favorable than ordinary income tax rates for those eventual distributions. What about a custodial Roth IRA? The rule here, of course, is that the child has to have earned income. But if the child does have income from a job, mowing lawns, working at a grocery store, I'm funding that custodial Roth IRA first every time. Simple, tax-free growth, no comparison to the Trump accounts there. So ask yourself a few questions before you decide what to fund and whether these accounts are right for you. What's the intended purpose of the money? Retirement, college, a home down payment someday? Do you expect to receive free money through government contributions, employer contributions, or qualifying charities? Always pick that free money up if it's there. When will the money be used, and what is the probable tax situation at the time? Bottom line, is this account aligned with my long-term gifting goals for my kids, legacy plans, and should I be setting aside money now to cover the tax cost of the plan if you want to convert it to a Roth account later? These are all the right questions. The answers will tell you whether the Trump account is right for you and if it belongs in your financial plan or not. So if you found this information helpful, share it with someone who's asking about Trump accounts. If you want to sit down and think through whether one of these accounts makes sense for your family, reach out to us here at Create Wealth Financial Planning and book a free intro call. Would love to help you figure out the right move for your house.